Hello, this is Beast McFeast with the first video in my Retire Early series, where we will cover investments and investing strategies that can help you to reach a comfortable retirement. Today we will discuss something called closed-ended funds, or CEFs. We'll cover several aspects of CEFs, specifically what is a CEF, how do they perform, what are some interesting CEF choices, what to look for when buying CEFs, and finally, what are the pros and cons of CEFs? Before we get too far in, I want to be clear. I'm not a financial advisor, and I do not endorse any specific investments or investing strategies. Investing involves risks, and you should know your risk tolerance. Not all investments have a place in your portfolio. You should exercise discretion. So, what is a CEF? It's a type of mutual fund. You can trade them throughout the day, very similar to an ETF. But again, unlike an ETF, they don't add additional shares. They have an initial offering. That number of shares is it. There's no creating new ones or destroying non-used ones. And this persistence of shares creates some interesting performance out of these. Like ETFs and mutual funds, these are professionally managed, and as part of that management, they are frequently leveraged, which is going to give you a very different performance depending on which CEF you purchase. So let's take a look at CEF performance. Your closed-ended funds typically have high yields, with an average of 6.7% in reference to their net asset value. And that's going to become important later. You can see that this is much higher than your typical ETFs, where you frequently see 1 to 3%. And the outliers in ETFs are higher, like the ever-popular QYLD at 12%. This does come at a cost, and that cost is in higher management fees or expense ratio. The average expense ratio of CEFs is about 1.09%, 1.1% essentially. Some of these get above 2%, but if you play these right, you can get that back pretty easily. And you'll see that some of these have very, very strange performance that you don't get out of any other investments. One reason for their odd performance that you might see in your portfolio is that CEFs, because they don't create or destroy shares, can be purchased below their net asset value very frequently. Not just like 1 to 2% below their net asset value, but 10%, sometimes more. So let's take a look at some CEFs and talk for a few minutes about how they perform. And at the end of the whole video, I'll mention 2 additional ones that are my top picks because they have some outstanding performance things going on. The first one we're going to look at is AOD. It's Aberdeen Total Dynamic Dividend Fund. This is not a leveraged fund, so you get rid of some of that leverage risk, which can be concerning. Honestly, if you have a leveraged portfolio and you are going through a down market, it hurts really bad, and you don't want that if you're looking at retirement. And you can see here, we've got an expense ratio of 1.18, which is pretty high. It's very high, to be honest. I don't like that necessarily, but it'll work out on this one because you see a 6.71% dividend distribution, which is a little misleading because the historical dividend yield on this is actually 12.24, which puts it up there with much higher performing ETFs for a somewhat similar cost. And you have to remember, you're going to try to buy all these at below net asset value. So your actual yield is going to be higher than the historic and proposed dividend yield if you can purchase below net asset value. And this one has a monthly dividend, which a lot of people like. The next one is QQQX. As you might expect, it tracks the NASDAQ. This is called the NASDAQ 100 Dynamic Overwrite Fund. Again, this one's not typically leveraged. Its yield is a little more modest at 6.09%. It has a lower expense ratio than many of the CEFs, but it's still higher than your typical ETFs. It's about right for a high dividend yield ETF that's actively managed, though. Again, we're going to see the historical dividend yield on this is actually 8.24%. So they seem to be under-promising and over-delivering so far. This one works pretty similar to QYLD in that they essentially run with covered calls, and they have a dividend distribution that is quarterly. Now, BGIO is an interesting one. It's the BlackRock Global Income Opportunity Trust. This will give you bond exposure around the world, which can be risky depending on where they're getting it and the quality of the bonds. So I'll admit I'm a little hesitant I will say 40% of this, or roughly 40%, is US bonds. So, I mean, that's not bad. And their written dividend yield is 11.63% with a pretty average expense ratio for this type of investment. Their historic yield is 15.72%, which, if you're familiar with the high dividend ETFs, this blows that out of the water. And they disperse these monthly. They're not opposed to leverage when needed. It kind of varies in this one. Now, what's really cool about BGIO is they have had some higher dividends. Like lately, they're not technically special dividends because that's a special class of dividend. They released some high dividends that were in the $1 to $2 range. And when you're considering that this is actually $5 per share, $5 to $6 per share, dividends in the $1 to $2 range that come as a surprise in addition to your regular dividend is pretty spectacular. In the past 3 months, if you had these, you were getting an extra dollar a share in your account. It's ridiculous. The next one is BDJ. This is another BlackRock. It's the BlackRock Enhanced Equity Dividend Trust. It's U.S. equities only. They try to get a 6.02% dividend yield, a lower expense ratio. The historic yield is actually 8.54%, and this is very low leverage, like between 1 and 1.5 times leveraged, which is not terrible. But again, in a down market, it hurts. And this is covered calls in your very stable, high-value investments. So they're going to have to be leveraged to give you this kind of yield. Next, we're looking at PIMCO's PDI. It's called the PIMCO Dynamic Income Fund. Now, PIMCO has several CEFs you might want to look at, and their website is pretty easy to navigate to get an idea of what they are. This one has a high distribution yield just below 10 with a historical yield of 11.77. So again, we're real high. And they do bonds and mortgage-backed securities all around the world. Well, in any reasonable market anyway. Their leverage is at, last I checked, 1.7 times. So that's the highest leverage we've seen so far. And today the S&P dropped almost 3%. So these guys probably took a hit. And they distribute their yield monthly. Finally, we're going to look at IFN. This is an interesting one because it's the India fund. And as you might expect, given the name, based in India. They are shooting for 9.84% distribution yield. This is on the rise because the historic yield is actually 9.31, so not the best. But if you're trying to get into an up-and-coming market, India is hard to beat. They have low leverage, at 1.05 times, which is really low, barely leveraged at all. So it's good that they're getting this kind of return. And they do mostly quarterly distributions with the occasional surprise dividend. So what should you look for when you're buying a CEF? Well, the first thing is definitely the discount. You want to buy below the net asset value because it's an option. I mean, getting a 10% discount on something that tracks the S&P 500, for instance, would be spectacular. To do this, if you just want to find good discounted CEFs, you can often screen through your broker, but if your broker doesn't offer it, you can go to cefconnect.com. They have a screener that you can specify. Like, I only want to see CEFs that are trading at 10% or more below net asset value. You want to look into these things in terms of how their net asset value has changed to ensure that it's not declining to pay the high dividend yields. This is a concern with high dividend ETFs as well, which often don't increase in value but dilute shares. So these are a little different. They can increase in value while still paying high yields, possibly, but some do not. So you really want to look at how they've historically done. As you might expect, a history of dividend cuts is a red flag. These are usually preceded by a reduction in net asset value. Before buying these, you want to make sure that the sector the fund is in or the type of fund you're interested in fits in your portfolio well. I mean, if you've got a bond-heavy portfolio, maybe don't buy a bond-heavy CEF. Pretty straightforward there. For retirement, you really do want a diversified portfolio to provide yourself with some additional security. Don't limit yourself to one sector. Finally, you want to consider what you are trying to achieve with this investment. Do you want monthly income in retirement, or maybe capital appreciation leading up to retirement, or some combination in the middle? Personally, I like to go to one of the extremes. If I want monthly income, I'm going to go for monthly income without much growth because that's not my objective. If I want to grow my account to where I can retire early, I'd look into growing my account and maybe sacrificing some dividends now. I'll tell you now, a lot of the CEFs that are growth oriented do pay a respectable dividend that you wouldn't see out of a comparable ETF. So what are the pros and cons of CEFs? Well, pros, as we've seen, are high yields, the potential to buy at discounts, no share dilution, you can buy and sell at any time, the potential for additional surprise dividends, and they allow for broad market exposure. A lot of these have global market exposure, which is pretty great. The cons, you might have to wait for the discount to come around. Sometimes they aren't trading below net asset value, which if you want to dollar cost average can be difficult. But if you're investing in several CEFs, you might find it easier to find one on discount at that time. I might not do dividend reinvestment on this because I'd want to let that save up until it's trading below net asset value and take advantage of that discount. The leverage on these can be damaging in a bear market. I mean, there's no way around that. And you're not going to get these high yields without some sort of leverage or options trading that exposes you to additional risk. Obviously, higher management fees are undesirable, though this is a trade-off for not having shares diluted, which in your highest dividend ETFs, like QILD, for instance, releases about 100,000 shares a week, which is why it's range-bound between $20 and $26 for its entire existence. You'll see that these are often not as range-bound, especially with their net asset value. Some of them climb quite high while still paying a high dividend. These can be more volatile than your traditional mutual funds, which, if you're in retirement, is maybe not the best. And your tax implications will vary quite a lot, which is similar to other types of investments. But I will say that good management goes a long way on this because they can try to limit your tax exposure and help to return capital more efficiently to you. One way they do this is by holding things long enough term for long-term capital gains to hit. So they'll hold holdings for at least a year, then sell it again, while cutting off their losers prior to 1 year to write off some of that loss. Another way they do this is return on capital, similar to QILD, where you don't pay taxes on that dividend because it's actually them giving your money back to you. Some may even try to invest in tax-exempt or tax-reduced investments. So earlier, I promised you some great CEFs, in my opinion at least. My two top choices are EVT and CET. They are some interesting picks. EVT is the Eton Vance Tax Advantage Dividend. As you might expect given the name, they strive to keep your tax basis low. And while they're doing this, they deliver 7% dividend yield. EVT is typically leveraged at the 1.25 times, so a bear market is going to hurt you a little bit more. But this is not so much that it's going to be catastrophic like you would get with like a 3 times or the 1.7 times CEF we mentioned earlier. You might not need this in like a Roth IRA because you're already getting a tax advantage status there, but it's a good pick in most portfolios and other accounts. So the next one we're going to look at is CET, Central Securities Corporation. The listed dividend yield is 1.67%, which is nothing remarkable. But the actual historic yield on this is in the 2 to 3% to 3.5% range. So it's better. Either way, the dividend beats SPY and VOO, which are its number one proxies in the ETF world. What is really great about this is that it has outperformed the S&P 500 over the last 10 years while paying you more along the way. This might be best for investors looking for a high growth and diversification pick prior to switching to a more income-based portfolio. An additional note is that CET has posted some higher dividends along the way, higher than anticipated, that put it up beyond their expected dividend yield. So if you're lucky, you'll get some of these higher dividends, which will boost your yield. I want to thank you for watching. Please leave any questions or ticker recommendations in the comments. If there's anything else you'd like to hear about, please let me know in the comments. Good luck. Get rich. Bye.